Hello, I'm Haider Malik, host of the Mehmi Financial Group podcast. Today's topic is 3PL expansion working capital loans in Mississauga. As your third party logistics operation takes on new clients, warehouse space and payroll costs spike before you invoice, meaning you need flexible funding to bridge the gap. Here's how to structure a working capital facility that fuels your growth without sidelining cash flow. Cow 1. Why a dedicated working capital loan? Bridge timing gaps. Cover staffing, fleet fuel, inventory stocking, and cross dock fees while you wait 30-60 days for client payments. Preserve asset lines. Keep your equipment loans and real estate mortgages untouched. Use a revolving facility for OPEX. Scalable to volume. Easily increase borrowing capacity as you onboard seasonal peak clients or open new warehouse bays. 2. Loan structures to consider. Receivables, secured revolver. Advance up to 80% of your approved client invoices. Interest only on used balances, ideal when billing is lumpy across large shippers. Inventory backed line. Pledge in stock pallet volumes, packaging supplies, or cross dock equipment for a revolving facility. Advance rates of 50 to 65% of market value. Unsecured term loan. 6 to 12-month term, up to 25-50% of last year's revenue at prime plus 1.53%. Useful for one-off investments in racking, software, or yard truck fleets. 3. Finding the right lender. 1. Local banks and credit unions. Meridian and Alterna have logistics desks that understand 3PL cost drivers. 2. Specialty finance firms. Non-bank lenders underwrite on client contract strength and warehouse utilization rather than pure balance sheet metrics. 3. Government-backed programs. Canada Small Business Financing Program shares risk on working capital loans up to $1 million, often shaving 0.5% off your rate. 4. Key terms to negotiate. Interest-only draw periods. Pay just interest during peak investment phases, equipment rollouts, or new customer onboarding, then amortize. Flex-up options. Ability to increase your line without full re-underwriting as your throughput grows. Covenant light. Favor simple borrowing-based tests over rigid coverage ratios to accommodate the seasonality of freight volumes. Prepayment and renewal. No penalty lump sum prepayments when large client invoices clear. Option to extend the facility as you add lanes. 5. Managing your facility. Bundle 1. Strategic drawdowns. Borrow funds immediately before major payables, driver settlements, carrier invoices, yard leases to minimize interest days. 2. Rapid repayment. Funnel large client remittances into principal reduction to restore capacity for the next volume spike. 3. Monitor KPIs. Track days sales outstanding, DSO, and days payables outstanding, or DPO. Aim to keep DPO at least 5 days longer than DSO for a healthy cash cycle. 4. Communication. Keep your lender updated on new warehousing contracts, lane expansions, or equipment acquisitions to maintain trust and speed future draws. 6. 3 action steps. 1. Audit your receivables and inventory. List your top 5 clients by contract value and your key in-stock assets, pallets, packaging, or yard trucks, and gather recent aging reports and appraisal values. 2. Solicit term sheets. Request proposals for receivables revolvers, inventory lines, and unsecured term loans from 2 banks and 1 specialty financier. Compare rates, advance percentages, and covenant terms. 3. Stress test scenarios. Model a 20% surge in volumes or a 30-day payment delay to ensure your blended facility covers peak to off-peak gaps without covenant breaches. By layering receivables, secured revolvers, inventory lines, and short-term loans, and by managing draws and repayments precisely, you'll secure the working capital to scale your Mississauga 3PL operation smoothly, win new contracts, and keep your warehouses humming. I'm Haider Malik. Thanks for listening.